Hey everybody, this is Mark Kelly from University Financial Strategies. So I just wanted to help give some more perspective around what's happening with your portfolio and give you some investment implications for what's happening, the coronavirus, the COVID-19. And so the first thing I wanted to start out with is this chart. And so a lot of times we talk about, why are we sticking with the same investments? Should we be raising cash? Should I be doing something? And this ties into a lot for the reason why we use the speed limit, or we say the risk number. And so that number we use is important because we're trying to help you understand how your portfolio should, what should be happening in your portfolio when things like this do happen. So a lot of times when we first do the risk number, we're actually doing what's called a stress test, and we showed you things like the credit crisis from 2008, 2009. Also on the positive side, what happens to the portfolio in terms of a bull market. So right now, obviously, it's the markets have had a steep decline over a very short period of time. A lot of that has to do with the lack of information, and so I'm going to talk about that in a minute. But I think this is an important slide for you to understand because unfortunately, we can't time the market. I'd love to be able to say, hey, I can, pull in a bunch of cash and then I can get back in the market just in time. Well, the reality is, I'll tell you that I don't have a crystal ball. No one does, and anybody who tells you that they do isn't really giving you the best advice because unfortunately, what will happen is something may happen just as suddenly as the coronavirus showed up that may help us on a positive side. And so this is why this portfolio is basically saying about staying fully invested. So if you missed some of the best days, you can see what happens in terms of your returns. And so this is why we want to try to stick to that risk number and understand that you will have volatility. And I wish I could take that away and not have you watch that. But what I'm also trying to do is make sure you have an understanding that we're trying to invest for the longer period of time. And try to fund other goals. Because really, with stock, like in stocks, when we see the market down, your portfolio is only down relative to the risk number that you take. So we say a 73 is the S&P 500, but if you have a 55 portfolio, you're not going to be down as much as the so-called the market, okay? Because we are trying to have a diversified portfolio with many different asset classes. We're not trying to pull one asset class out of another, but for the most part, we're trying to have a core portfolio. Perhaps maybe it's in large cap U.S. stocks, but then we're going to build around that. And so wanted to provide some perspective on that. Also, I did want to understand is that in terms of the what happens with COVID-19. I mean, right now it's about the lack of information, and so I think what we're going to see is obviously, as we see more cases, as we have more testing, that's going to have an impact on, on some emotions. But I think it's, if we have to also look at things like what really is happening. So, like, obviously, if the disease were to continue to spread the same pace and with the same mortality rate, it would, obviously, would have a devastating human toll. Obviously, that's a very grave situation. I think there's some reasons to believe that those numbers will probably improve in the weeks ahead. Because, what's one thing is that we see on the news is about the mortality rate. And right now they're just using a simple calculation of it's really the calculation of the cumulative deaths divided by the cumulative number of confirmed cases. And, this is because there, are very likely many more mild cases of the virus that have not been reported. And then, so it's just a math equation there. And then second, there are some countries, like most notably South Korea, that really appear to be succeeding in halting the growth of the disease through the widespread testing and social distancing. I do see a lot of people questioning that and making fun of that. And honestly, at first, I probably had some feelings about that myself, if I'm being truthful about it. But the reality is that the idea is just because of the curve. We're trying to manage it for the healthcare impact so that we're not overwhelming our healthcare system. And so, but I think if you look most recently, the number of cases in South Korea, it rose about 14%. And so the mortality rate that I was seeing based on a report from JP Morgan was that it was just 0.9%. So that's well below the 3.5 percent number that we're seeing is be reported outside of China. And so also I think too, third, there may be some seasonality in the virus. Obviously, as witnessed, we see there's actually lower cases in the southern hemisphere, and and whether or not there's better treatments and eventual vaccine, that should in time really greatly reduce the mortality rate and prevent it from spreading. So really, having said all that, so the world really has woken up to the real threat of COVID-19, and the private responses have triggered really a large change in lifestyles. I have many friends right now that are questioning, oh, why can't I do things? Or, why can't I go out? But I do think we have to take this seriously. Obviously we've had cancellation of major organized sports and entertainment events. Airlines. People are not flying as much. Hotel bookings, cruise lines. Obviously, and then I think there's issues like with restaurants, bars, anything like a service organization, anything with retail traffic. So obviously, all those things, and another thing is even the closure of many schools and colleges. Although I think in one thing I do find interesting that if we look back at things, 10 years ago we did this, there would be a totally different response. Now you have a lot of schools going to online classes. So it's not a complete stop. It's a change in how we do things, but you can do virtual classes. Like a lot of times I help clients, we can talk virtually as well, and do online things. And so that at least is kind of a positive, I think, for the economy. And so I just want you to understand that as well. But in terms of the impact, I think, from what I've been, reading and looking at various sources, is that, we're probably, because of the late stage of the, when this hit in the first quarter, we're probably still going to have a somewhat still solid first quarter. But, unfortunately, it looks like with everything happening, the U.S. will probably enter a recession in the second quarter. And then it could be very severe in terms of initial decline in GDP. So maybe I'm hearing anything from a decline of 5 to 10% in the second quarter, and then from there, I think there's also maybe a potential decline in the third quarter as well, but probably not as severe. And so having looking at that, I think in the best case scenario, really social distancing is going to it achieves, it really helps it to achieve a sharp slowdown in the spread of disease and obviously fatalities, hopefully. And then this will allow us the government to kind of authorize a slow return to normality. Although probably still some restrictions in terms of social distancing, and but even with the I think there's probably going to be impact in terms of the unemployment, especially on the service organizations. It's also, but I think it's also important to recognize that this recession that we're going to go through is really quite different than 2007 to 2009, and that recession was really centered around it's really the construction and financial services industry, the housing and banks. It was very significant from a corporate earnings and stock market perspective, somewhat less from a GDP perspective, and less significant from an employment perspective. Despite the unemployment rate topped at 10%. I think, as I said, this is really going to be centered around the leisure, entertainment, and food service and retail sectors. That's from my understanding, it's about a fifth of U.S. unemployment, but probably less significant from a contribution to GDP as other aspects of the economy. Um, but but I think the thing is the most immediate impact of the recession should be there will probably be a sharp rise in unemployment. We are at 50-year lows in terms of unemployment. We're at 3.5%, and so I think that's kind of the impact. I think corporate profits, although very cyclical, it should probably fare better than the great financial crisis. Um, so just those are some of the things that I'm thinking about in terms I want you to understand as well. And then from a monetary and fiscal response. So monetary is we're talking about the Federal Reserve. So we've seen the news about the Federal Reserve dropping rates to zero, and so that's part of the equation. The Fed cut the federal funds rate by a full 1%, and it goes from a range of 0 to 0.25%. And then they followed that with another. That was followed by another. That was following the 50 basis point cut, or 0.5%, so 0.5% on March 3rd. So, and then the other thing they're doing is they're actually going to be buying treasury bonds and what was called agency bonds. So like agencies like housing bonds. So they're buying that, and the impact of that is that it actually controls the interest rates as well. So there's going to be a lot of things there which are going to improve. And so like if you're looking to refinance your mortgage, that's probably not a bad time to consider that, because money will be cheaper. I think there's other things too, just to let you know, internationally, other central banks are also in an easing mode, and that's trying to coordinate with what's going on in the U.S. There's also, when we say fiscal side, there's going to be things that can be stimulus that we talked about the payroll tax cut. That could be something. There could be things to improve unemployment insurance. And so those are the things that are being worked on. Hopefully we get some news on that in the next, this week, hopefully. But I think those are things that are, trying to add in some protection for small businesses. And then, as I said about the employment, so trying to enhance the unemployment benefits. And, it's unfortunately, it's probably going to be good over the longer term, but in the immediate term, in the second and third quarter, I think that probably, we're still looking at this strong decline. So that's kind of the things to think about. But in terms of getting back to the portfolio, I mean, this, although this sounds all dismal, I think it's also, important to think about, all these things and what's happening. So we're looking at, we're looking at different valuations. So like where I've been talking about at the end of the year, in the beginning of the year, that the valuations on the markets mean that what's called the price to earnings ratio of the markets on a forward basis was looking elevated. So obviously now we're the valuations are much more attractive for long-term investors, which is what we want. And so that's an important consideration. And I can show you. I've shown charts before that we're trading below the 25-year average in terms of price to earnings ratios, and that's usually how markets are valued, by the valuation or how it trades relative to earnings. And so, I want to reiterate that I don't think the world is ending. I don't think that your portfolio is going to go to zero, because mostly what we're trying to do is we're reason why we use diversified, a lot of indexes, some active funds. We use a lot of different things is because we're trying to diversify the portfolio to a maximum state, so that you can understand, so that we can control some of these things. We can't control everything, but that diversified approach is going to happen. But so really, the bottom line here is that the idea is we want to maintain a disciplined approach to investing. you know, I think, recognizing that no matter the trauma that's caused by this virus, I do think that these are all temporary. And so if we look at 2020 as the year, quote, of the year of the virus, then more likely I would say that 2021 will most likely be the year of the recovery from the virus. And then the value of the stocks depends on earnings for years and decades into the future, not just the year ahead. So when we value stocks, stocks, we're looking at what we say in perpetuity. What's the valuation? So when I talked about multiples, about the earnings multiple. So the earnings certainly in the short term do have an impact, but really we're buying stocks for a long period of time, and that's kind of the valuations that we're talking about when we're buying stocks. And I also think while many will have the urge to reduce risk, that's the quote I said, they want to do something in their portfolios. I think they should really kind of recognize that to some extent the market already has done that for them. So like if like a simple portfolio that's weighted 60% to the S&P 500 and 40% to the Barclays Ag, which is the fixed income index. At the start of the year, it's going to drift. It's probably below 55% in stocks now and 45% in bonds. It's probably closer to 50% in stocks and 40% in bonds, just because of the market declines. So that's an important thing to remember. So part of what the important thing we do is we're going to make sure we go back and rebalance that, because we want to buy some of the stocks on from a valuation perspective. Since the values come down, we want to raise our allocation to stocks somewhat, being mindful of what's happening. Okay. And then the other thing too is I do think valuation matters. So for long-term investors, even given a social distancing recession, market moves probably have enhanced that perspective long-term from equities, while reducing them for bonds. So that's what I was just trying to say about how that allocation change has an impact. And I do, and people also will question about, should I invest in emerging markets or developed markets? So that's like Europe, Asia, kind of internationally. I would say that that's also an important consideration, because they do have a valuation advantage over U.S. stocks, and that's particularly given the value of our dollar. So the U.S. dollar is probably a little bit overvalued in itself. So there's some difference in currencies, which has some benefits there. Next thing too, I'd say, is that the plunge in interest rates, both at the short and long end, meaning it's that the short-term bonds and long-term bonds really, that's going to cause investors to look for income from a different place, because so we looked at a 10-year treasury bond. It's 0.70%. You're going to get less than 1% for a 10-year investment. So anybody that's in retirement, it's not like you could do in your maybe when your parents were retired, where they could just clip coupons and live off the interest. It's just not the case, because it's such a low rate and it's below inflation. So typically we're trying to find investments that are going to keep up with inflation, so we can maintain the purchasing power of your money. Okay. But I think what the thing to think about is looking at dividend paying stocks, and then maybe some other alternatives such as real estate and some other like infrastructure funds. But if the real estate is, you have to think about what's the right REIT, because you also want to be careful of some REITs are really just invested in stocks, so we want to be mindful of that. And so I think that's kind of, I just want to send out that message. I know that it's not the most comfortable thing. I feel it myself. I invest just like I'm investing for you, and so it does have an impact, and no one likes going through this. But again, we want to just make sure we're looking at what is your long-term goals, and tie that to financial planning in terms of the market reaction. Because I've said this in other blogs and different posts, is that I still remember the different. I remember the .com period. I remember the Great Recession of 2002, 2008, 2009. And I still remember. I always talk about this. Is I remember talking to someone on the soccer field in 2009, March 9th of 2009, and why that's significant is because I remember that person telling me they got out of the market and they were so panicked. But the problem was that March 9th of 2009 was the bottom of the market. So to just give you perspective, the Dow Jones was at 6,666. Okay, kind of all sixes, and so if you'd sold out there, that's exactly what this chart is talking about. Is trying to time the market. We up until like a month ago, we were close to 30,000 on the Dow, so it would have been 4 times that bottom of the market. And so that's the message I wanted to convey to you. I know this is a little bit longer, but I did want to make sure you're getting good information, because again, it is easy to watch the news. News, as I always say, again, is constantly negative business channels. The CNBC, okay, they're trying to sell advertising, and so I want you to be mindful of that. That if you're reading that and it scares you, I want to give you some perspective. And as we're in this social distancing period, I would offer up that if you'd like to schedule a time, we can do it virtually. So it's an exciting time to learn about virtual cases, how to manage things remotely. So anyway, just wanted to put that out there. Feel free to give me a call as well, 919-391-7526. Okay, thanks so much.